Hello, welcome to Any Answers Answered for June 2019. Two questions, as ever, that Tim and I will have a look at from the pages of Any Answers on accountingWEB. The first one is a question that does crop up from time to time, and it relates to the difference between what is a phone and what is a computer. These days, phones are far cleverer than they used to be. The question comes from the rather wonderfully named I Really Should Know But, who asked the question about a £1,000 mobile phone. Ordinarily, he says, we permit a phone per director, but I'm wondering for how long HMRC will agree that the latest phones are designed or adapted for the primary purpose of transmitting and receiving spoken messages and used in connection with a public electronic communications service. As he points out, these people are more interested in showing off with their phone than they are about the phone calls they make. The question is, I suppose, Tim, is that still a phone, or does it become a computer that's being provided?
It is still a phone, and I can understand the reason for the query. We are looking at significant expenditures now, and of course that is a very useful exempt benefit. If a company provides, let's say, a director or any employee with the latest iPhone costing £1,000, the company can claim tax relief on that cost as part of their remuneration costs. If it's an exempt benefit, that's very tax efficient. And the answer is it is an exempt benefit. We should, of course, remind everyone that you can only be provided with one mobile phone. Any additional mobile phones would be taxable as benefits using the normal 20% of annual value rule. But we need to look at the revenues manual. Looking at the answers on accountingWEB at the moment, I can't see anybody referring to them. But the revenue, actually the questioner had it in the question, EIM, Employment Income Manual 21779. And it first reminds us of the change to the definition of mobile phone back in 2006-07 to include apparatus designed or adapted for the primary purpose of transmitting and receiving spoken messages and used in connection with a public electronic communication service, etc. But then the revenue go on to say that where apparatus is clearly designed or adapted for the primary purpose of transmitting and receiving spoken messages, the fact that it can also be used for other functions will not prevent it from falling under the meaning of mobile phone. And this means, and I quote, that smartphones will fall within the meaning of mobile phone. It's worth noting, say the revenue, that certain devices that were primarily designed and adapted as personal digital assistants, PDAs, I had one myself, the old Scion personal digital assistant, in the past have evolved over time so that many modern consumer PDAs are likely to be smartphones. It's also worth noting that it's an area of rapidly changing technology, not possible to be certain about the application of the definition of mobile phone to future or new forms of smartphone. But at the moment, it's pretty clear that iPhones, Samsung, Android phones, there are other brands, do count as mobile phones, not as PDAs or computer equipment, and therefore you can provide it as an exempt benefit.
And of course, many years ago, it was actually a taxable benefit. Was it £200, I think?
That's right, there used to be a 200 quid benefit.
And then they decided it was harsh to do that because so many phones were cheaper than £200. Now we're bizarrely in a world where it's an exempt benefit and they actually cost an awful lot more than that. But as you say, that doesn't change the fact that they are phones, full stop.
Yes, I mean, two further points. The exemption covers the phone itself, any line rental, and the cost of private calls paid for by the employer on that phone. And so if, and it's important that the contract is in the company's name, the employer's name, so if the employer either buys a SIM-free mobile phone and provides that to an employee, that's covered, or if the employer signs the contract for monthly rentals on such a device, that too will be covered.
Good. Our second question is...
Final point.
Oh, sorry, go on.
Don't forget the optional remuneration arrangements. I came across a case recently where the director shareholders were each provided with one iPhone, and 3 or 4 of the senior staff were also provided with one iPhone, but the difference was the director shareholders just took the iPhone. There was a salary sacrifice arrangement in place for the senior managers of, I think, about 750 quid each. And that salary sacrifice means that the exemption is overridden by the relatively new optional remuneration arrangement rules, and you would now have to put the 750 quid salary sacrifice on the P11Ds as mobile phone benefits for those employees who had a salary sacrifice, but not for the directors who didn't suffer a salary sacrifice.
Because it is the greater of the two potential liabilities. Our second question comes from Arthur Allen, a question on taxation of joint savings income. The client has joint savings account with his wife. He is a high rate taxpayer. She is a basic rate taxpayer. He wants to allocate all the savings to her. However, says Arthur Allen, I have advised that if the accounts are straightforward accounts set up in joint names, there is no option to allocate the savings anything other than 50-50. Tim.
Correct. He goes on to say that he believes this is unfair. Life is unfair, we just have to get on with it. And unless I'm missing something, my understanding is that we'd need to set up a savings account in her sole name in order to achieve this income split. I mean, I think he means in order for all of the
income split, yeah.
Yeah, so this is a classic case, actually, of what many taxpayers and a few agents get wrong. The rules for jointly owned assets are very straightforward for husband and wife and registered civil partners. If you have a jointly owned asset, unless it's close company shareholdings, the default position is a 50-50 split, irrespective of the actual ownership. But that 50-50 default split for income tax can only apply if it is jointly owned. Here, if it's wholly owned by one of them, there's no way that you can transfer half the income or any of the income to the other one for tax purposes to get the tax advantage you're after. But if they were to have a joint savings account, rather than put it wholly in the wife's name, it would be possible, if this is the sort of husband we're talking about, to have a declaration that the beneficial interest is, let's say, 99% his and 1% his wife's, and make sure that you've got that written declaration signed, sealed, not sealed, but signed and keep it as evidence if asked, and then put half the interest on her return, half on the husband's, because the default position will still be 50-50. However, and we've covered this before, if it is jointly owned in unequal beneficial ownership, such as the 99-1, and you don't want the default 50-50, you then complete the Form 17, declare on the Form 17 that it's actually 99-1, and you must then follow 99-1, which wouldn't do them any good because the husband wants it going to his wife, not 99 on his return.
Exactly. So
but it can't be retrospective either. That can only be from the date of the, or whatever the time action is, of the Form 17.
Okay, so the point is that as it stands here, there is no way of transferring money entirely to her, but there are ways and means of getting...
Well, they can transfer the money.
They could transfer the money, but without transferring the money,
is.
you're going to struggle to get... Well, you wouldn't be able to get it all into her name, but there may be ways of structuring it, some to her, some to him, differently from 50-50, but only with the supporting documentation to prove the point. Hopefully useful. As ever, we look forward to looking to next month and taking a couple of questions from the pages of Any Answers. Until then, bye-bye.